Stop trusting the financial gurus. You've heard the generic rule, 10 times your salary. It's wrong. That number doesn't know your $400,000 mortgage. It doesn't know your child's $150,000 college dreams. And it doesn't know the single greatest fear keeping you up at 3 a.m. Listen, if you passed away tomorrow, your family has a financial number they must hit to survive, stay in the house, and keep their dreams alive. You need to know that number. Guessing is gambling with their future. In the next few minutes, we are ignoring the textbooks and using a powerful two-step calculation I call the worry-free gap method. By the end of this video, you won't get a guess. You will have the exact personalized dollar amount that acts as a fortress around your family's future. Grab a piece of paper and a calculator because this is the most important math you will ever do for the people you love. To figure that out, we need to look at two key sides of the equation. Think of it like a scale. On one side, you have all the financial obligations you'd leave behind, the debts, the costs, the needs. Let's call this the final bills and immediate needs. On the other side, you have the resources your family already has to cover those obligations, your savings, your investments, any existing policies. This is your existing safety net. The gap between these two sides is the amount of life insurance you need. It's that simple. So let's build this equation, starting with the obligations. Step 1. Calculate your final bills and immediate needs. This is the total amount of money your family would need to cover everything right now. We're going to break it down into 5 categories. First, and usually the biggest, debt elimination. We're talking about debts that would be a heavy burden for your family. List them out. Mortgage, the total remaining balance on your home loan. The goal here is often to use life insurance to pay off the house entirely so your family has a guaranteed rent-free place to live. Other loans, car loans, significant credit card debt, personal loans. Student loans, both your own and any future loans you're co-signed on for your children. Add all that up, that's your number 1 bucket. Second, final expenses. This is the immediate, unavoidable cost of your passing. Funeral costs, burial or cremation, medical bills not covered by insurance. This can easily reach $15,000 to $20,000 or more. It's best to be conservative here, so let's use a round number of $20,000 as a starting point. Third, income replacement. This is the core of the replacing your paycheck idea, but we need to be smart about it. We're not necessarily replacing your salary until retirement age. We're creating a financial runway for your family to grieve, adjust, and get back on their feet. The question is, how many years of income replacement does your family need? For a couple with young children, it might be until the kids are grown up and out of the house. A common method is the DIME formula, which stands for debt, income, mortgage, education. For income, it often suggests 10 years. But let's make it even more tailored. Ask yourself, how long would it take for my spouse to become self-sufficient if they needed to? Could they finish a degree, enter the workforce? This period could be 5, 10, or 15 years. So take your annual take-home pay, not your gross salary, but the actual money that hits your bank account, and multiply it by the number of years you choose. For example, $60,000 take-home pay times 10 years equals $600,000. That's your income replacement bucket. Fourth, future obligations. This is where you fund your family's dreams. College education. Estimate the future costs of college for each of your children. A rough estimate for a 4-year degree in the future can be $100,000 to $150,000 per child. So for 2 kids, you might add $250,000. Other goals. This could include a wedding fund, seed money for a family business, or a special needs trust for a dependent who will require lifelong care. Fifth, a cushion for unexpected costs. Life happens. Cars break down, roofs leak. It's wise to add a buffer of maybe $20,000 to $50,000 for these unforeseen expenses. Now pause. Add up all 5 of these buckets: debt plus final expenses plus income replacement plus future obligations plus cushion. This total number might feel huge and even a little overwhelming. That's normal. This is the worry-free number. This is the total financial obligation. But now we bring in the relief. We look at the other side of the scale. Step 2. Subtract your existing safety net. Your family isn't starting from zero. You likely already have some assets. We need to tally these up and subtract them from that big obligation number. Existing life insurance. Do you have a policy through your job? A group policy. Add that death benefit here. Savings and investments. This includes your liquid savings, retirement accounts like 401ks and IRAs, and taxable investment accounts. Important note, we typically do not include the equity in your primary home here because the goal is often to pay off the mortgage, allowing your family to stay in the house without a monthly payment. Adding the equity would be double counting. Now take your total obligations from step 1 and subtract the total of your existing safety net from step 2. The final calculation, your magic number. What you're left with is your target life insurance coverage amount. Let's do a quick simplified example. Let's say a person calculates obligations, mortgage, $250,000, plus final expenses, $20,000, plus income replacement, 10 years times $60,000 equals $600,000, plus college for 2 kids, $250,000 equals $1,120,000. Safety net, existing work policy, $50,000 plus savings $30,000 equals $80,000. Need $1,120,000 minus $80,000 equals $1,040,000. So a policy of around $1 million would be the target. Now, you might be looking at your number and thinking, that seems high. Is this realistic? Remember, the goal of this exercise is to create a complete picture. It's your North Star. It might not be the policy you can afford right this second, but it's the number you work towards. If the number is higher than you expected, don't panic. You can adjust the variables. Maybe you start with a 7-year income replacement instead of 10. Maybe you focus on the absolute core needs first, mortgage, debts, and 5 years of income, and then add more coverage later as your budget allows. The power is that you are now making an informed decision. You're not just guessing or following a generic rule. You have a plan based on your family's specific life, debts, and dreams. So your action step after this video is to sit down with your partner, grab a calculator, and walk through these steps. It might be one of the most important financial conversations you ever have. You came into this video asking, how much life insurance do I really need? And now you have the answer. You need enough to bridge the gap between the financial life you've built for your family and the resources they'd have without you. You need enough to turn their what if into we will be okay. If this was helpful, please give it a like and subscribe to the channel for more clear, actionable insurance tips. Click on the video showing on your screen now to learn the common mistakes people make when buying life insurance so you can avoid the pitfalls and get the right policy. Thanks for watching.